Well, Liberation Day came and went, and the market responded in some massive sell-side activity across the board in these markets. These type of days we haven't seen like in the S&P 500, Nasdaq, and so forth for a long time. Like, look at this SPY. We were down 4.93%. We'll call it 5%. We haven't seen that since coming out of the pandemic in June of 2020. If you look at the Qs, we haven't seen a move like that since 2022. And that was kind of where we started capitulating to find some sort of a bottom at the bear market. And in IWM, you have to go back to 2020 as well, coming out of the pandemic, to see a move like this. This has people kind of thinking about, oh, shoot, are we going to start to see them circuit breakers? And well, we got pretty close in the IWM. We look for a 7% drop for level 1 that gives you a 15-minute halt. Then you go down to a 13%, another 15-minute, and it gives beyond that. We stop for the trading day, but that did not happen. On today's Stock Market Brief show, look, we got a lot to discuss. I'm going to be following up on the big picture charts just to revisit the context of what we've been kind of sharing, and then I'm going to drill it down into the smaller time frames. Let's get into today's show. All right, people, welcome back. We're looking at the SPY on the weekly time frame here. We're sitting at about lows for the week and for the trading session on the day. For the week, we're down about 3.3%, continuing to follow the path of this declining 5-weekly EMA and following through, if we zoom out on that negative divergence that has now officially played out to the downside. These things do help. Are they always going to play out quite like this? Well, no, but if you go back to when we were pointing it out, it was one of the many different signals that we were looking at that could potentially lead to some sell side. You can see that here going into 2020. You can see that over here going into the bear market of 2022. It wasn't until we found the bottom where I actually started seeing positive divergences, where we started to kind of pick back up through those areas. And as it stands right now, we have a MACD that's basically pointing straight down, RSI that's heading towards that oversold condition. Now, if you were trading intraday today and you were watching net flow, this entire day basically said, hey, step aside, watch out. We had the cumulative net premiums for puts going up, diverging from the cumulative net premiums of calls, and this was heading down below the zero line here, and we've had convergence throughout pretty much the entire trading day, which just tells you just watch out, right? Especially after the market's trying to digest some big news that many people said was going to be like a non-event. Well, they were absolutely 100% incorrect, and anybody that tries to predict that stuff, to me, is just bonkers, because we have no idea what was actually going to happen. We got to look at some of these individual names that took it on the chin today. I'm looking at large cap names, so large plus as far as market cap goes, and I just have them listed down here 1 through 40, and I'm just organizing them from biggest percent declines. Look at Carvana. This thing was down 20%. Dell, right, down almost 20%. You had Best Buy over here down 17%. These are some bigger names throughout here that just absolutely 100% got obliterated. Nike was down 14.44%. This one I'm actually interested in building a position for longer term in. You had all types of names just get absolutely hammered. One of the ones that's not on this list because it's smaller than a large cap is Restoration Hardware, and they reported earnings today and we're down almost 40% or 40%. I pulled up their chart on the weekly time frame, threw a VWAP onto the IPO where it started, and look at that's kind of where we're at right now, and it fell within like pandemic fashion. This is the pandemic over here, hit it like a freaking rock. Fed actually stepped in and did something, and then it reverted. We have no Fed yet, but we'll be talking soon. Now, if you were watching when they announced the tariffs, you may have seen the Nasdaq futures, if you're watching that, all of a sudden stop trading. That was not necessarily one of these circuit breakers or limit downs. There is a thing called velocity logic through the CME. And this is, I guess, important to know now when you start to see more volatility, just in case if you're trading all of a sudden freezes up. But they have this mechanism or algorithm that does price banding, and they time it. So it's basically showing how fast an underlying asset moves within these bands within a certain amount of time. They'll freeze, they'll stop the market from trading for whatever that time may be, and it'll to reduce that volatility in it. And that actually took place about 15 minutes or so into that tariff announcement. Now, tomorrow we got non-farm payrolls coming out. So this is another big event, and this is taking place as we're already kind of at the weekly expected move, and the market's pricing in some massive volatility. So I'm going to share with you I'm doing this on the fly here because I didn't even create a slide for it, but I'm going to go ahead and share with you the expected moves for the expected moves. Sorry, I'm trying to like pull this out of my screen right here. The expected moves for tomorrow's trading session. I'm going to do that in the expected move section. We'll hop into the big picture, and then I'll show you not only the SPYs Qs, but I'll give you an idea of the SPX and some other products there too as well. But we're going to get into the big picture charts here and walk through that. So this is the big picture chart I've been sharing for quite some time. And the reason why I do it is just because to me, this is very interesting, right? If you look at the S&P 500 from a monthly perspective, there's been many times where we hit new all-time highs, and people are saying like, hey, this time's different. We have a yield curve inversion, but it's different this time, right? It's different this time, and it's probably different this time, whatever the case may be. But I do find it very interesting that when the Fed started to stop raising rates, then we went to a rate cut cycle. We started going to a cut cycle, and then we're going through a cut cycle right now. And then the yield curve started to uninvert, and we started to bring rates down. Well, what happened here and there? And over here, right? Well, we had the dot-com bubble burst. We had the great financial crisis. And is this the early something of a bigger sell-side activity to come? Perhaps, right? We don't really quite have that answer yet, but what we do have is what happened historically in kind of similar conditions as far as looking at the yield curve, this curve being the 10-year 3-month, and down here being the federal funds rate. You can also look here at IWM on the weekly time frame. I've been kind of tracking this channel out here, and you can see really the times that the market, IWM that is, did really good was when the Fed slammed rates to zero and then the market climbed. And then over here, we slammed rates down to zero and then the market climbed. When we started lifting rates and cutting them down, right? Lifting rates and cutting them and then pausing, the market went sideways. Over here, the market kind of went sideways, right? And then you have the yield curve down here doing the same thing, uninverting. One thing that I added differently in this chart was the RVX, which is Russell volatility. And you'll notice that we've had some sort of volatility event that really caused them to move those rates down around the same time as that volatility event. This was 2020, the pandemic. This was the great financial crisis. Okay. So is there going to be a similar vol event in the near future that potentially brings us down to this lower channel? Maybe even we get some sort of exhaustion kind of move through it that forces the Fed's hands to move rates down at a faster pace, ultimately giving what this administration, I believe, wants. Another interesting chart was a larger time chart is the BKX or the KBW Bank Index, which is the more larger institutions. I believe there's 23 or 24 in this index. And I've been following this one for a while too. There's this I just call it the red zone up here, which is a potential area of resistance. But every time we've come into this red zone, there's been some interesting things that happen. For example, over here was the financial crisis. Over here was going into 2017 and then going into the trade war. Over here, when we're clawing our way back, the pandemic. And then over here, right, we went into war, and then we also had inflation concerns and stuff like that. And then now we're back again, and it's like trade war part 2 with Trump back in office. And if it's going to be like trade war 2.0, well, remember that whole end of December, right? December 2018, we saw that Christmas Eve massacre to actually really give us that capitulation. Now, I don't think it's going to play out the same way. I have no idea. I'm not calling for that, but it is just an interesting analog to continue to watch. I've been showing the Dow Jones Global Index here too as well, and you can see when we get to the upper portion of this channel, right, we've seen some resistance other than right over here and right here, right? But right here, we had the Fed step in pretty hard. We've overshot it for multiple months, and then we started coming back in, and look where we hit right there at the bottom channel during the war and the inflation. That was actually the top print for inflation right there. We had that Christmas Eve massacre down here, global growth scare right over here. We had Operation Twist over there. This is dating back to 2010. And where are we now? We're up at the upper bounds of this channel. We're kind of coming in a bit here. You have the price or the percent price oscillator starting to curl over. You have a negative divergence on the RSI, albeit that it's a really large one. So who knows what can be the driver force, but is this possible to come down in this channel? Well, I don't want to say it's not possible because it happened over here and 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 it happened over here. Okay. So that would be That would be pretty big, right? So we got to just manage risk as we see fit. If you look at the SPY on the monthly time frame, we do have the percent price oscillator crossing over here to a bearish crossover. As we kind of weighed in on this in prior months, how we closed below this. And it looked like we can potentially, if we were to bounce back up to and around 5,800 was the level we talked about. I don't remember when. I think it was actually just a few videos ago. That could be the level to potentially watch. Well, we didn't quite get there. We got to 5,700, 5,695, and we started kind of reversing. Now we're coming back to that middle monthly Bollinger Band, which is the 20 period moving average there. Now, a big point in all of this is obviously we've been showing the federal funds rate. Well, what is the market actually pricing in? Well, there has been some changes after today, go figure. And we do have Jerome Powell speaking tomorrow, right? So we'll see if that adds to any change here within this probability tool. But what do we see here? Well, in May, that's the next meeting, we're looking at keeping rates where they are. However, right, who knows what might shake things up to make it look like an emergency cut, right? We talked about this a few videos ago, how the market might start trying to price in 4 rate cuts, maybe perhaps an emergency one in May. Well, that was not the case so far. However, you can see that they did start pricing in 4 cuts. You can see a cut here in June with a 65% probability, a 50% probability, a little bit higher, right, in July, and then September, October, another rate cut, and then into December, another one. That's 1, that's 2, that's 3, and that's 4 rate cuts being priced in. And we'll see here what the market does, and if it kind of forces the Fed's hand by any chance to potentially push rates down further or to remain where they are, right? They said that their mandate here, I mean, obviously they do say that they watch the market and the volatility of it and everything, but their main goal is to have inflation target of 2% and unemployment rate at a decent level here too as well. So if unemployment shoots up to the rockets and inflation stays where it's at or potentially even rises, we'll see how the Fed kind of talks about that and deals with that. Or if inflation comes down, and unemployment goes up, right? There's so many different scenarios that can happen, right? Potential stagflation is on the decks too, even though that he said he believes that there is no stag and no inflation like a few meetings ago. It's crazy stuff. Crazy stuff going on. All right, let's look at some of the intramarket charts because this is also just some huge moves here in FX markets. So if we look at just the trade-weighted dollar over here, massive move, down 1.4% today. Boom, breaking. We saw a little bounce over here. We saw a little bit of bounce over here. This is following really the path of the 2017 dollar when Trump had his first year in office. So this thing's coming off pretty hard and fast today. Remember, when volatility kind of hits like this, you can see movements in both directions in a rapid fashion. The 10-year yield also took a big hit down today, down 3.36%, but off of the lows. You might look at this as a potential head and shoulders pattern, right? So if you measure the high to there and measure it down, maybe perhaps we see rates back at 3.6 at some point, but who knows how smooth of a ride that's actually going to be. With that move down, TLT was up slightly, but it closed near the lows of the trading session. I did buy some down here. I got out on this day on the open. I also traded down over here and got out here and here. And now I'm just waiting for price action to kind of consolidate, tighten back up again, and maybe I'll look to re-establish some trade in TLT. Oil, huge hit today, down 6.6%. You got to be wary of moves like this in oil because oil is such a large commodity. And when it falls like this, there's definitely concerns for the economy globally and here in the States as well. But with the fall like this, you got to keep a close eye on it because this can spark growth concerns and potentially even recessionary fears. And you got to understand the reason for this too is rates typically follow. And you could see that here, right, where oil found a bottom over here in September, bounced up, and then rates follow. That's the candlestick says the rates. The 10-year yield, right? Sorry, the oil fell over here. The 10-year yield there followed there shortly after. And you can see they're moving hand in hand today. So if oil continues to see sell side, that could definitely spark some growth concerns and some fears. If we take a look at gold took quite a big hit today, but it did recover well off the lows, kind of closing flat for the trading session. But we started the day at a new all-time high with a pretty large reversal candle. So maybe perhaps we're reaching an area here where it starts to consolidate a bit. And this move coming flat was also to slightly down was on a falling dollar. Silver absolutely brutalized, down 6 on the trading session, a large candle over here. So we'll probably see some snapbacks of some sort in the near future. Just be very cautious over here. I looked at the chart of miners, and miners were rather unscathed on the day, and they have a pretty tight correlation. So if silver continues this path, I would think that miners are going to follow suit with it. Copper also down 4%. Now, copper, right, has the PhD in economics, and a lot of people have been talking about, well, I don't really see recessionary fears because copper has been rising. And I think you got to kind of look at multiple things when you put this together. And one of the ratios that I would say take a look at is the copper to gold ratio. Gold has been known to be a safe haven, right, a flight to safety. Copper has been an economic metal, and it's been rising, so people think, yeah, no, economically that's great. But what about its comparison and relative strength to something like gold? Well, take a look here at the monthly chart for this. This is copper to gold. That means when this line is going down, gold is actually outperforming copper. When the line goes up, right, that means that that copper is outperforming gold. So going down has not been a good thing. You can go back to like 2008 and see it's straight down. Over here into the pandemic, it went down. Over here into mid-2016, it went down, right? And where are we now? Well, it's actually down, and now we're getting some pretty big hits here as we were just coming off a high over here on copper. So definitely some concerns from an intermarket standpoint. Let's look at market conditions right now. First, I want to look at the curve for the VIX futures. We are still in backwardation, which tells us what? It tells us, and this is a pretty smooth backwardation over here, it's telling us that we got problems here and now. You can see that in the tape, obviously, because the volatility that we've been just dealing with today. So we got problems here and now. You want this thing to curve like this, where we look into problems in the future, but right now it's pretty extensive. You can see back month, first front month, took it on the chin here, went down a little bit further. We're down at around a reading of 0.91. Typically when we're under 1.0 with this, it's typically tries to find some sort of a base, some sort of a bottom. Intermediately, we got down here prior, we bounced up, based out, we came back down. We were down here around 1.0 just on my last video. Then we had the tariff announcement helping drive this down even further. So just be aware that this is a pretty frothy reading we really haven't seen for some time. And when we did, that was like the August bottom. And then over here, we saw this move, pretty strong move to the downside. Then it reverted back up to following to some more sell side activity. We're well below the gamma flip line, which is roughly at about 56.80 now. We'll see if that updates come tomorrow morning. This is where selling begets selling, buying begets buying. We've now been here for 31 or 32 trading days under the gamma flip line. So this has been an environment for much shorter term trading, for smaller positions, for wider stops, not for your average swing trader. It's been just a much more difficult environment. That's why we look at these market conditions. This is one of the factors that determine how I trade and what strategy I trade. When I'm below a gamma flip line, I'm typically much more active from an intraday perspective. And when I'm above a gamma flip line, I look to swing trade for longer periods and holding periods. We're down here roughly at about 5,400, which happens to be right at around the put wall. We'll see what this looks like come tomorrow. This is about 5,300 down here. It's growing in size. And we got about 5,500 right over here. That's another level of interest from a gamma exposure standpoint. CTAs have been massive sellers for us. It's starting to look like it's flattening out. We'll see if that turns around. And then also vol control funds have been a huge component to all of this sell side activity that we've been seeing here in the equities. If we take a look at the direction of the 5-day moving average, which is the second thing that I look at as far as determining market conditions and what strategy I'll be trading, we're red across the board here. That means they're below their declining 5-day moving averages in SPY, Q, IWM, semiconductors, biotech, and DIA. If you like these type of charts, you can check out Gamma Lab. I have a pinned comment down there below, pinned, and you can use code MSD50 to get 50% off of your first month there. It's pretty rad, amongst some other links that I have. Let's look at now the expected moves. So first and foremost, we have exceeded the lower weekly expected move, and you got to be very careful here because the market priced in quite a bit of volatility, and right now, it's not handicapping it well in this current context. It doesn't mean we can't bounce back up, but just be aware that when we start breaking from these weekly expected moves, it could get very nasty and very quick. And tomorrow we have that data coming out for jobs. And we don't know how the market's going to anticipate this one. So just be aware that, hey, if we start breaking down, this could be like one of those August scenarios of last year where we're down in the first few trading days of the quarter, down at the quarter to date. Now, I'm not saying that's going to happen tomorrow, but that's what happened in August. If you remember, if you've been watching the show, in about 3 or 4 trading days, we were down at the quarterly expected move. And that was actually an area that we had labeled out for a potential opportunity to quote unquote buy the dip. We're still above the monthly implied move, which is at 532, and it's only day 3 of April. So yeah, just massive volatility on today's trading session. I'm going to share with you now the expected moves for all the products that I share with my Discord community. So if you want to be part of the Discord community and get this little sheet sent out daily, as well as with the Mag 7, which is one of my proprietary setups for daily expected moves based off of implied volatility. For the Mag 7 stocks, I share that there too as well in this Discord community. You can check the pinned comment. It's $9 a month. It's not expensive at all for what you get. You get a lot of different trade ideas when we're in better market conditions. I only post a few right now, actually a few for the last 30 days because we've been in negative gamma. I give an updated watch list and tight list. I give weekly expected moves, quarterly, monthly, daily. You get the access to the Tradie Ticks bots, which a whole bunch of different bots there with options flow kind of stuff. And then you also get to the query channel where you can type in various commands and you can have a specific chart pop up, like, for example, market net flow. So if you want to check that out, make sure to check that one out too. If you want to screenshot this and have these levels for tomorrow, make sure to put them on your chart because these levels are crazy. And by crazy, I mean the SPX is a $90 expected move. SPY is a $9 expected move, and the Qs is an 8. First and foremost, when the SPYs have a larger expected move than the Qs, something's going wrong right now in the market. Something's off. This does not happen. I'd have to go back through my history. I have all the data there in the Discord to relabel out the times that the SPY had a larger expected move, but it's always times of massive, like kind of more panic, capitulatory type stuff when you see this happen. And I don't know if we're moving into capitulation yet or not. I mean, looking at the S&P 100 advanced decline today, it didn't really seem like a capitulation, even though that it was a lot of selling taking place. But that is a massive move. This is honestly, I mean, look at the $9 of expected move. Okay, so I hope you screenshot it. I'm deleting it right now. These are weekly expected moves, right? 14, 10, 14, 15, 12. $9 is for one day. This week over here, right? That was the weekly expected move. Tomorrow's expected move is this size. So absolutely crazy. What's it look like on the chart? SPY, it's right now outside of the weekly implied move. If we do tag the lower implied move and get continued sell side, that would be under the monthly, and the daily would be down here at around that 527. If we start snapping back to the upside, I'm watching this VWAP right here. This is the closing VWAP going into the tariff announcement, and you can see we sold off into the weekly expected move. We bounced. We hit that VWAP and we rejected from it, creating a new low. So we have a high, a lower high, we have a low, we have a lower low. So if we start doing something like this and potentially breaking back above the VWAP, to me, that would be a much more better situation to know that the average person that's been buying since the tariff announcements would be then technically in the green based off of that time and that volume. So that would be a more bullish situation. If not, then just be patient right now. You got to be very patient and very tactical. What I say typically, if you're trading or swing trading, you want to go smaller positions in higher volatility, right? Smaller positions and wider stops, and be okay with losing, because you got to trade the plan or create a plan and trade that plan. And then, or if you're more tactical, you can go on smaller time frames and trade at a more tactical pace. So right now, also, if we look at Qs, we have the declining 5-day moving average. We've already stated that. Week to date, month to date VWAPs down here too as well. Daily expected move can bring us down to the lower monthly implied move, and we're outside of the weekly as it stands right now. If we start come down here, whatever the case is, and we start bouncing back up, at some point, just watch the week to date, watch the month to date, watch the declining 5-day moving average, because these can act and come into confluence and act as a level of resistance or potential resistance. So you want to be just aware of all of that. If we take a look at a couple of signal charts right now, there are some that are getting really extended now. You see the bullish percent index for technology sector now has a bullish divergence forming now after we saw a massive sell side. I would think that this would have been steeper to the downside, but it's not yet. But we do have a bullish divergence here on all this sell side. If we look at the bullish percent index for the Nasdaq Composite, we have a positive divergence forming here too, and we're getting pretty extended here on the bullish percent chart, but we were much more extended here going into 2024 at the bottom of that market correction right there. And we have the bullish percent index for the NYA, the NYSE, bullish divergence there as well, and not really too extended of a reading overall like we saw back in late 2023, marking that bottom. That's all I got for you on today's episode, everybody. I hope it helps out, gives you some insight. Look, if I was to conclude this, I'd say, simply put, make sure your seatbelt is on, take your foot off the gas a little bit, turn on the windshield wipers. It's storming out there. That's the analogy that I would use. Or if you're like fishing or you're out on a boat on the ocean, it's choppy waters. So just do your best to navigate it. And the way that you do that is simply by, one, taking your foot off the gas, lower amounts going into each position, widening stops, stepping to the side for a little bit, whatever the case may be for your particular situation. But you got to have risk at the forefront of everything that you're doing. Hope that helps, and I'll see you later.